Welcome to Breaking News to Trading Moves, where we look at the headlines and try to figure out exactly where the capital is flowing.
Good to be here. And we have a very specific catalyst to look at.
We certainly do. The headline event is the decisive election victory of Japan's Prime Minister, Sanae Takaichi.
But this wasn't just a political story, was it? The market reaction was almost immediate.
It really was. We saw Asian markets jump pretty much across the board, and Japan's Nikkei index, it just surged to fresh records.
And that didn't just stay in Tokyo. We saw a broad risk-on tone start to emerge globally. Specifically, here in the U.S., chip stocks saw a pretty sharp rebound.
Right. It feels like one of those situations where one major positive event happens and the others start to line up. But before we get into the specific names, and we do have a lot of tickers to get through, let's set the macro backdrop here. Why did this election result get such a positive response?
It all comes down to policy expectations. The market is looking at Takaichi's win, and, well, it's pricing in expansionary fiscal policy.
Which means what exactly?
Yeah.
Stimulus.
Stimulus, yeah. Tax cuts, and also specific investment in themes that are already popular, like AI and semiconductors.
So more money flowing into the system.
That's the idea, and you have to pair that with what's happening over here in the U.S.
The Fed.
Right. Markets are increasingly pricing in a possible Fed rate cut by June. And on top of that, you've got a heavy slate of U.S. data jobs, inflation, spending all due later this week.
So traders are getting positioned ahead of that data, and they're using the news out of Japan as a reason to buy risk.
That's a good way to put it.
Okay, so that is the setup. Our mission now is to look at that headline and move straight into the specific winners and losers. We want to identify the ticker symbols and, the logic behind their movement.
Sounds good.
Let's start with the winners then. The first sector that really stood out was semiconductors and AI compute.
This is the area that saw the most immediate benefit. It's that risk-on correlation in action.
Can you explain that correlation a bit more? Why does an election in Japan help a chip company, based in California?
It's all about global growth sentiment. When Japan and other Asian markets rally, it tends to signal confidence in global manufacturing and technology demand.
And U.S. growth stocks, especially the cyclicals like chips, feed off that optimism.
They absolutely do. It's a rotation back into what everyone is calling the AI infrastructure trade.
I see. So a rebound in one of the key U.S. chip names tends to lift the whole complex with it.
Precisely. Investors see a green light in Asia, and they decide, okay, it's time to put capital back into the hardware that powers the global tech economy.
Let's get to the names then. These are the stocks that tend to lead the charge. First on the list has to be NVIDIA.
Ticker NVDA. Of course.
The heavyweight in the AI space.
It is. It's almost a proxy for the entire sector at this point. When risk appetite improves, money flows there first because it's the most direct play on that AI build-out we just mentioned.
Okay, next up we have advanced micro devices.
AMD. It's a similar logic. If the market starts to believe that global tech spending is set to increase, whether from stimulus or just better economic conditions, AMD is seen as a primary beneficiary.
Then we have Broadcom.
Ticker AVGO. Broadcom's a critical piece of the connectivity puzzle, a lot of networking, custom silicon. So when you get a broad lift in the sector, AVGO almost always moves with it.
And finally in this group, Taiwan Semiconductor.
That's ticker TSM. And this one is, of course, directly connected to that Asian market sentiment. As the main manufacturer for all these other companies' chips, any positive news in the region is good for their story.
And it's worth pointing out, these are all high beta tech stocks.
Yes, that's a key point. That means they tend to move more than the broader market. So if the S&P 500 is up a bit on this global growth optimism.
High beta tech is often up a lot more.
Exactly. That's the leverage to the risk on tone we're seeing.
Okay, let's move to the second sector in the winners column, U.S. industrials.
And this connects directly back to the policy side of the news.
Right. We talked about expansionary fiscal policy. That usually means building things, doesn't it?
It does. Pro-growth policy expectations, they just improve the whole outlook for global capital spending. If Japan is going to stimulate, and if that feeling spreads, then the companies that sell big machinery and automation equipment are positioned to gain.
So when markets lean risk on these cyclical industrial suppliers, they catch a bit. Who are we looking at here?
First one that comes to mind is Caterpillar.
Ticker CAT.
Right. CAT is the classic bellwether for global construction, for mining activity. If there's an expectation of new infrastructure projects or just a healthier global economy, CAT is often the first place industrial investors look.
And next is Deere.
Ticker DE. Now, people often think agriculture, but deer is also heavily tied into the broader machinery cycle. It trades on that same global capital expenditure outlook.
So if the global economy is expanding, people are buying more heavy equipment.
Simple as that.
And the third one in this industrial group is Honeywell.
Ticker HON. Honeywell is a bit more diversified, but it has a really strong angle on automation and industrial tech. And why is automation so important in this specific context?
Well, because if a major economy like Japan is pushing for modernization and efficiency as part of its fiscal policy, that usually involves upgrading industrial systems. Honeywell sells the tech that goes into those factories and buildings.
So the logic is pretty direct. Policy promotes growth. Growth requires equipment.
And these are the companies that sell the equipment. That's the flow. It's a rotation into what we call cyclicals, stocks that do well when the economy is cycling upward.
Okay, so let's look at the third group of winners. This one might seem a bit different from chips and tractors. We're talking about precious metals miners.
Right. This is where we get into the currency and the interest rate side of the equation.
We mentioned earlier that the market is pricing in a possible Fed rate cut, and there are these expectations of expansionary policy in Japan. How does that connect to miners? Well, often when you have expectations of rate cuts or stimulus, the US dollar can soften a bit. And a weaker dollar typically helps commodity prices, especially gold and silver.
And if gold and silver prices move up, the miners make more money.
It's all about leverage. That's the key word. Miners are leveraged to the movement of the metal itself. So if the price of gold goes up by just a small amount, the profit margins and the cash flow for the mining companies can increase by a much larger amount.
Who are the big players to watch here?
Newmont is the first one, ticker NEM,
NEM. Got it.
the world's largest gold miner. If investors are using gold as a hedge or just riding the momentum of the metal, NEM is a very liquid way to get that exposure.
Then there's Barrick Gold.
Ticker GOLD. The ticker says it all, really. Similar to Newmont, it's a massive producer. If these macro crosscurrents like the yen moving or bond yields shifting are pushing investors toward hard assets, Barrick benefits.
And one more in this group. Hecla Mining.
Ticker HL Hecla is important because it gives you more exposure to silver. Silver often moves with gold, but it can be, more volatile. So if you're in a broad precious metals rally, HL tends to do very well.
So we have semis, industrials, and miners all moving up. But a market rotation implies that money is moving from somewhere to somewhere else. Not everything is going up.
No, absolutely not. And identifying the losers is just as important for understanding the whole rotation.
Okay, let's look at the losers. The first sector taking a hit seems to be oil and oilfield services.
This is the other side of that rotation.
Why would energy stocks lag if the market is positive about growth? Shouldn't that be good for demand?
It's partly about the narrative. The market is rotating toward growth and tech, that risk-on trade. And at the same time, we've seen crude prices dip a little bit.
So you have a headwind from the commodity price and a headwind from where investor interest is going.
Exactly. The story has shifted away from inflation and high oil prices, and it's moved to tech growth and stimulus. Energy stocks can get left behind.
The names here are the big integrated majors. First, ExxonMobil,
Ticker XOM,
and Chevron.
ticker CVX. These are huge companies. When asset allocators decide they need to be overweight technology, they often have to sell something to fund that purchase.
They become a source of funds.
That's right. They sell their energy or defensive holdings. We also see SLB on this list.
Who it is?
Ticker SLB. It's an oil field services company, so they're more sensitive to the actual activity levels of drilling. If the sentiment on oil prices softens, the outlook for drilling activity softens too, and SLB feels that.
Okay, so energy is out, tech is in. But not all defensive stocks are safe either. The second group of losers is what you might call defensive yield plays.
And this all comes back to the bond market.
We mentioned bond yields might be a bit twitchy. What does that mean for these stocks?
It means even though there are bets on a Fed cut, global yields are still volatile. If yields move higher, or even if they just stay choppy, investors start demanding a higher return for their risk.
And these defensive stocks, they're usually bought for their dividends, for their yield, correct?
Correct. They're bond proxies. If I can get a decent risk-free return in a bond, I might not want to hold a utility stock that carries equity risk. So when yields are competing for capital, these rate-sensitive defensives tend to underperform.
And who are the specific tickers to watch in this space?
NextEra Energy. Ticker NEE.
NE.
It's a major utility. It does have growth components, but it's still highly sensitive to interest rates.
Then you have Duke Energy.
Ticker DUK. A very traditional, regulated utility. These are the kinds of stocks people hide in when they're nervous. When they're not nervous, when they're risk-on, they sell DUK to go buy NVDA,
An American Tower.
ticker AMT. This is a real estate investment trust. They own cell towers. And again, they are highly sensitive to interest rates. If the cost of borrowing goes up or if yields rise, REITs generally face pressure.
Okay, so we've got energy and defensives lagging. But here's the third group of losers, and this one is actually within the tech sector itself. We're calling them the AI spending skepticism laggards.
This is a really crucial distinction to make. Not all tech is moving up in this rally.
We saw the chip makers soaring. So why are these other big tech names lagging?
It's a debate over who actually captures the money from AI spending. Right now, investors are rewarding the direct winners, the companies selling the chips, the compute power. They're less enthusiastic about the broader enterprise tech companies that are talking about AI but still need to prove they can generate real revenue from it.
So it's the difference between selling the shovels in a gold rush versus promising you might find gold eventually.
That's a fair analogy. The market wants to see clear AI-driven revenue acceleration. If you're a legacy tech company and you don't have that clearly on the books yet, you might be used as a source of funds to buy the chip stocks.
And the names in this bucket would include Oracle,
Ticker ORCL,
IBM,
ticker IBM,
and Cisco.
CSCO, yes. These are all solid, massive companies. But in a very aggressive risk-on rotation that's focused on AI infrastructure, they're seen as show-me stocks. The market is saying, show me the growth, whereas with the chip stocks, the growth is already being priced in.
That helps clarify why we see that kind of split within the NASDAQ itself sometimes. Okay, so we've covered the winners, semis, industrials, miners, and the losers, energy, defensives, and some of the legacy tech names. What do we need to watch next?
We have to keep our eyes on that data cluster coming out of the U.S.
The jobs, inflation, and consumer spending reports that are due this week.
These releases are critical. They could easily swing the pricing for that June rate cut we talked about. If the data comes in hot, that rate cut bet might fade and this whole risk-on mood could reverse.
But if the data is soft?
If it's soft, it might just reinforce the trade and add more fuel to it. It's the reality check for the market's current optimism.
And what about outside of the U.S. data?
You have to watch the yen. Yen volatility is a key signal. Since this whole discussion started with Japan, it's fitting we keep an eye there. If the yen moves sharply, it can change the risk appetite for global investors pretty quickly.
And global yields in general.
Absolutely. If yields spike higher, those high multiple tech stocks, the NVIDIAs and AMDs, they can start to look expensive very, very fast.
It really highlights how interconnected it all is. A political event in Japan sets off a chain reaction that moves a tractor company in Illinois and a gold miner in Colorado.
It's all one big flow of capital. Understanding the headline is just step one. Understanding the rotation is where you actually see the market mechanics at work.
A good place to leave it. Just a reminder, though, markets can move fast, and these rotations can reverse just as quickly as they start.
That's always true.
Absolutely. And before we sign off, our mandatory disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. You should always do your own research.
Oh.
Thanks for listening to Breaking News to Trading Moves. We will catch you on the next one.